Hi, I'm Niël Pretorius. I'm the Chief Executive Officer of DRDGOLD. We are a listed company, Johannesburg Stock Exchange, as well as the New York Stock Exchange. Our operations are in Johannesburg, and we focus exclusively on the retreatment of old gold tailings.
Niël, thank you for the introduction. Really good to be here talking to you. Very much looking forward to this. It's labelled a technical interview, so I'd like to get into talking about the projects and how you manage your operations and how you manage your costs and the outlook on all of that. But before we get into it, back in the day when I was an analyst in the city 20 odd years ago, one of the things I used to look at was Harmony and DRD gold as these kind of leverage plays on the gold price. And when I've researching for this interview, looking at it, I could see your share price was actually very similar, in some ways, kind of an exaggerated outline of the gold price. And it's funny that it's gone from being an underground operating entity to being of relatively small volume to being a surface retreatment company of relatively small volume. But in a sense, you've still got that leverage to the gold price. Perhaps you could kind of give me your thoughts about where the company is now relative to where it was as an investment proposition.
Yes, no, certainly, and the point you make is an accurate one. We have transitioned fully from deep level underground mining into the retreatment of tailings. So all the gold that we produce now, we produce from old mine waste. We do not add. We make the point, especially in the current climate, with focus on ESG, we do not produce any additional waste. We just retreat the waste that's already out there. But I suppose trading patterns are established over many, many years, and you do want to retain what's good in how the market deals with an asset. So whilst I think the business has become far more stable in terms of outlook, in terms of performance, no longer exposed to those risks that are peculiar to the deep level underground mining environment, we deliberately do not take any forward cover. So we take full exposure to the gold price. And whilst we have a very healthy dividend legacy, we've been paying dividends now for the last 15 odd years, and things are looking up also for another one, so for a 16th consecutive year. And we say to the market, if you buy this stock, then there is a 4, 5, 6% return on that. In addition to that, we do offer full exposure to the gold price. We don't hedge. So if you believe you understand the gold price and the dynamics that affect the gold price, then there's also some upside potential that you could take advantage of here. And the nature of trading in the stock is such that you could really take advantage of movements in the gold price both directions. It's a stock that is oftentimes very significantly shorted, especially in the United States, where I think we've had periods where you had up to 2 weeks of trade in the short position. I think it's very brave to do that sort of thing, especially with the frequency and amplitude of cycles nowadays. But people do that, and obviously also it follows the gold price back up again. So we do say to the market, even those who are long DRD do trade the stock, they do trade their portfolio, and we offer that opportunity, I believe, by taking full exposure to the gold price. And we don't want to change that. I mean, we want to show the market that, we have a handle on our costs, we understand our risks, we invest in the right sort of infrastructure, and we'll manage a gold business. You manage the finances associated or the dynamics associated with gold price. We're not bankers, we're miners.
So in a sense, leave it to the investor to choose whether they want exposure to gold or not, but you'll manage what you can control, which is the operation on the ground.
Exactly. If you want fixed income, then invest in fixed income. If you want exposure to the gold price, here's an opportunity to do that. We're not going to be a gold miner pretending to be fixed income.
Interesting. Now, one of the features of DRD in the old days was it's leveraged the gold price, as in kind of relatively slim margins. And you've said you've been you run a stable operating environment. I could see from your recent financials that you've got a margin of just under 20%. How have you managed that to maintain that margin in this very dynamic price environment, where not only have you had metal price changes, but you've also had your raw input changes. There's so much volatility in your underlying cost structure.
Yeah, no, absolutely. Look, the operating margins between 32 and 35%, and the all-in sustaining margin hovering between 16 and 23. But as you point out, you've got to be very mindful of your costs, because coming out of COVID, we have seen some logistical pressures. Global logistics have not fully recovered following COVID, and although we haven't really had instances where we completely ran out of certain reagents or supplies, we've got to manage it very carefully, more carefully than what we did in the past. Also, in our capital investment programs, you have to plan your programs, the components that form part of your projects. You've got to order those well in advance, because just in time is a distant fantasy concept. It simply no longer applies. Having said that, the margin is also attributable not just to how you manage your costs, but it's also a function of gold price. And although gold sentiment has been bearish for quite some time now, if this is a bad gold price, it's actually a very good bad gold price. So the dynamics that impact gold price, especially in dollar terms, and notwithstanding the fact that we've had a very strong dollar. In fact, the dollar is one of the few currencies that's outperformed the gold price in the last year. Notwithstanding that, the fact that the dollar is very, very strong, if you just look at everything that impacts our operations and the profitability of our operations and our exchange rate, the margins have been healthy, in part due to the fact that the gold price has been good. You do have to be very, very disciplined about your costs, and you need to understand your cost profile really well. And if you were to look at the presentation that we recently did in New York and also in Switzerland, we provide a breakdown of our costs, and you'll see that wheel looks like, that pie graph looks slightly different compared to your typical deep level underground mine. We do not have the extent of exposure to electricity, for example, electricity costs. Neither do we have similar exposure to labor costs. Our costs lie more in reagents, and these are things that I think you can manage if you do it carefully. And we cost on a per ton basis, so we literally look at what the cost for every ton that we process, and we do between 25 and 30 million tons per year. We look at the costs of every single ton, and we allocate costs on a per ton basis. So we know what the costs per ton are, what the breakdown of those costs, what that looks like, and also what the revenue per ton is. And you've got to manage it on, with that level of accuracy in order to understand it well enough. Because bad discipline and good discipline, it both apply equally. If you're really disciplined and you could save 2 cents per ton, you multiply that by 2 million per month, and you've got 4 million cents over a year. That's a lot of money. That could be 10% of your dividend. You do it the other way around. You start becoming a little bit lethargic or lazy or complacent, rather, when it comes to your costs, and you say, well, 2 cents here and 5 cents there doesn't really make a difference. It does make a big difference. And I suppose that's where, when you talk to third parties about bringing in resources, because 99.9% of what we mine, we earn, but we do bring in resources from time to time, provided we can verify source. And sometimes you would find it makes negotiating a little bit harder, because a third party would literally think I'm sitting on a gold mine, but he's not. He's sitting on a pile of waste. Once you start breaking down those costs on a per ton basis, they do remain marginal, and it's scale and throughput that really make the difference in the final analysis.
And so the cost differentiator that you're talking there is logistics, is the infrastructure required to get that low grade material from their site to your site, or to install a new processing facility at their site, or either, or both?
Well, typically, if you were to approach a third party, some of them just don't get it, and that's why some of the dumps in Johannesburg still remain unexplored, unmined, unfeatured. The thinking would be that I ought to claim a percentage of the gold content here, but there's not sufficient appreciation of the infrastructure, the point that you made, that's required to link it up with the rest of the plant infrastructure, with the rest of the circuit, and there's not an appreciation of just how marginal that really is on a per ton basis if you start doing that breakdown of the costs.
Yeah. Niël, thank you for all of that. I realize what we need to do is, could we just step back and could you just describe the two operations you've got and tell me a little bit about how, and the viewer, how much the how that process works?
Yes, certainly. So we have two main operating areas. The primary operating area, the one that sort of, let's call it the mothership, is in the East Rand. It's called Ergo. There's a smaller plant that forms part of the Ergo setup. It's an integrated setup called NYSE. And there we process mostly, at Ergo, we process mostly lower grade material. It's our high volume plant. So lower grade, high volume. And we have between 12 and 15 active sites that deliver material, or where we are busy either with cleanup and final closure associated with the cost profile of Ergo. So it's a fairly complicated or a complex recovery business with many different moving parts. And on average, about 1.8 million tons of material would be processed through this plant on a monthly basis. It also makes use of one of the largest tailings facilities in Southern Africa for the final disposal of the reprocessed waste. So the waste that we process does not get backfilled. It doesn't go back to where it came from. It gets moved to a different site, and this site is managed towards the standards of the ICMM and that which has been published by the GISTM. So the sort of the whole governance structure is informed by those standards. The process is to wash the material with a high pressure device into a sump, and then it gets pumped through a network of slurry lines to the processing plant.
So you've got 12 to 15 of those places where you've got 12 to 15 sumps. So you've got 12 to 15 different places where you've got these high pressure jets going in, washing the tailings into a sump and then connecting to a central facility.
Not quite as many areas or sumps where we pump from. About maybe just less than half of those are in fact areas where slurry from a number of different monitor guns would find its way into a sump. Some of the active sites are sites where we mechanically move material as part of final cleanup. But cleanup also involves the reprocessing of material lifted from site as part of the closure process. The fortunate part of it is that you can soften the impact of having to bring about final closure by in fact reprocessing the material for gold. And it's not always 100% profitable, but it softens the impact of those costs. It's not a pure rehabilitation cost or an outflow of funds. It offsets in many instances, in most instances, in fact, it does offset the cost of closure quite substantially. The reason why I mentioned the number of different sites is just to also later on emphasize the difference between the Ergo site and the Far West Gold site, which is the second site we have, and which we acquired from Sibanye-Stillwater a few years ago. But this network of pipelines, and they're fairly extensive. We pump up to 60 kilometers and return the water then back to the site because the water stays in the closed circuit as well. Again, mostly grey water. Very little potable water finds its way into our circuit. It's mostly recycled grey water that stays in circuit. That gets pumped back to the slurry site after it's been delivered to the plant, and the waste has been delivered to the tailings deposition facility. Water goes all the way back. The plant itself is a fairly conventional setup. It's carbon and leach. So it involves cyanidation, carbon loading, smelting, and electrowinning and smelting.
The gold that's in the tailings has already been processed once because it's because it's gone through. Do you need to regrind it, or is it simply that you've got better reagents, the better flocculants, better hydrometallurgy and better chemistry now than when they were originally mined? Or do you have to do some kind of liberation as well, physical liberation?
We do a bit of cycloning in some of the circuits. So there is a measure of milling, but it's a relatively small percentage of the total throughput that finds its way into a milling circuit. most of the material that we're processing now, it's ground to a fraction where you could treat it. You just need to manage your densities very, very carefully. So you'll find that there's a set of thickeners. You deliver it into plant at a particular density, and then you adjust the density for optimal leaching and cyanidation.
Talking to a metallurgist friend of mine, he said that quite a lot of the innovation in recent years has been about agitation and about in the tanks to make sure that the flows are correct, the circulation systems are appropriate. Is that? I mean, I'm just trying to get my head around how do you take something which has been through a plant once and recover gold from it?
Certainly. Look, I think the pumping itself also maybe it does. Let's call it polish the particle a little bit. So you might have more exposed surface as a consequence of the fact that it's a turbulent process. You don't have laminar flow in these pipes. You have turbulent flow in these pipes. Laminar flow leads to stratification and ultimately choking or settling down of material. So it's turbulent flow. It finds its way in the plant itself. I think some of the improvements that have been made in terms of recovery is the introduction of additional energy, like this, let's call it a giant spoon, the agitation. You've got to do it very carefully though, because you don't want to break down the carbon in the circuit. If you do agitate too aggressively, where you've already introduced carbon, you might cause the carbon to break up, and those carbon fines might find its way through the screen, and you could lose material that way. But agitation and also introducing oxygen under pressure. Those are two measures that have been introduced under more, I think, monitored circumstances or more monitored conditions, and that have certainly added to the efficiency of the extraction efficiency of these plants. I think something else that is also, that's made a big difference in how we manage, particularly the high volume plant. As just the nature of monitoring. So, a normal conventional plant is managed, I wouldn't say reactively, but you can react to what you observe. You observe and then you adjust. You see something or you measure something and then you adjust accordingly. Whereas a plant of this magnitude is managed more proactively. So you have to set it up according to a particular recipe. To use and excuse the fact that this is an oversimplification, but it's the best way to explain it. It's the difference between making a sauce, a pasta sauce, the difference between cooking and baking. If you cook, you taste and then you add a bit of spice. If you bake, the whole mix goes into, it gets prepared, gets stuck in an oven, and you take it out 2 hours later. And whatever you stuck in the oven, provided that the temperature was right, that determines the outcome. And our plants is more sort of the second process. You've got to set it up proactively, and then you need to identify, and we have identified, I believe, most of the key dynamics that impact operating efficiency, that impact performance. And those you have to manage and monitor. We, in fact, monitor those on a 24/7 basis. So we don't take sort of spot checks. We monitor it. So when you look at plant performance, you look at a graph with a pen that draws a piece of paper on a graph that rolls. So you can see this is where the pH was, and then this is how the pH is trending. This is where the oxygen levels were, etc., etc. This is temperature in the elution tax, etc. Or circuit rather, and those are then kept within range, and you optimize the performance of the plant with gentle tweaking and by trying to get these ranges to become tighter and narrower. But very seldom that you would have something nowadays that goes completely out of sync, temperature-wise or density-wise, or any of those things that in the past may have gone out of sync, and where you reactively address them with adding or withholding cyanide, or not cyanide, lime, for example, in order to manage your pH, etc., etc. These things are managed in a far tighter and a narrower range. And then there's several of them, 8, 9 of them that get monitored. The conversation also around the table, when you listen to the operating management, the plant management, so when they talk, the operators, And then I'm sort of, I'm the one listening in. I don't really participate in that conversation because I have limited understanding of what it is that they do. I have a legal background, but if you listen to the conversations now compared to what they sounded like a few years ago, it's far more analytical. So, but what does this trending tell us, and what does this trending tell us? As opposed to, tell me where you are in terms of flop, tell me where you are in terms of carbon, tell me where you are in terms of oxygen or pH, and then move it back to that. It's already there. The plant's where it's supposed to be. Let's debate its performance. We could do about it.
And is that a conversation which has evolved through the management and the development of Ergo and Far West? Is it something that the guys have learned on the job, so to speak?
I believe it's a consequence of how we decided to manage the flow of information. So instead of having a command control sort of flow of information, or let's call it a typical mining comms methodology, we decided to just make all of this information available so everybody sees the information. You very seldom report information. The information reports itself through the system. It's an automated monitoring system. Not everything, but I'm talking about these key dynamics now. So everybody sees all of the information, and everybody on your way to a meeting, on your way back from work, on your way to work, you're thinking through. So what is it? What am I seeing, and why is it behaving the way that it does? And I think spontaneously the conversations sort of then just developed into that direction. So you no longer go to your manager and say, this is what the plant's telling us, and then you receive your instructions. You go to your manager and the conversation is, I wonder why it's behaving like this, or do you think if we did that, it might be a little bit better, et cetera, et cetera. So you combine all of these different things. The fact that you've got massive throughput, the fact that you have these little tweaks in process, like your oxygen and your agitation, et cetera, et cetera. The fact that you've developed a recipe over time and that you've set it up in order to be able to monitor it properly and keep it sort of within range. And then this approach, this management system of how we converse about it, the nature and the content of the conversations that we have about it. And suddenly, when you look at your sheet at the end of the month, and in fact, we look at it 3 times or 4 times a day, but if you look at your report at the end of the month and you see, but actually the residues are trending favorably, instead of a point, instead of a 0.152, we actually managed a 0.150 this month. And it's only because, that tiny little bit of tweaking in the approach is brought about, and that's how a 2 million ton a month circuit that's how it either makes money or how it loses money through that
and,
sort of
can you just tell me how old are the tailings? Was this mined in the when were these tailings dumps laid down?
Yeah, so most of the ones that we've got now, there are still some pre-Second World War dumps. But not many. Not many. Most of those have been mined out. So most of the dumps that are coming through our circuit now are dumps that are younger, sort of post Second World War, sort of 40s and then onwards in the era past that. Some of them were obviously created before then, but they grew bigger afterwards. They contain a very significant percentage of material that was deposited post Second World War, but you don't really have many of the really old tailings left. So if you're looking at sort of the average in situ grade, then it's anything between 0.26 gram a ton to 0.34, 0.32 thereabouts.
And the kind of the heyday, the golden day of the kind of the volume days of the South African mining industry were 60s, 70s, and 80s. Is that right?
Yes, that's correct. We had 500,000 people working for the mining industry, and then very significant volume throughput as well. And that's where you sometimes strike a bit of good fortune, was where the volume throughput at the time was such, because of the quality of the ore body, that the mine at the time maybe would have sacrificed a little bit of efficiency in favor of volume throughput. If you're mining a reef that's 18 gram a ton or 16 gram a ton, whatever, you're not going to lose too much sleep over 0.02 or 0.03 gram of material left behind. So that's not going to be a big issue for you. You'd rather process more and maybe leave a tiny bit behind, which doesn't even move the dial in terms of your recovery efficiency standard.
So you want your good days are a reflection of bad plant recovery days back in the day.
Well, and sometimes intentionally so. As I say, sometimes some of these plants were run for throughput and not so much for efficiency. And they could change their mind if they wanted to, but why would they? Because they're mining 20 gram a ton.
Where are you? I know. Tell me about kind of mine life and the deal with Sibanye and Far West, and what the profile looks like going forward.
Yes, certainly. So I told you about Ergo, and I never got to Far West Gold. So Far West Gold was the it's the second part of the business. It's the second operating footprint that we have, and we were very pleased to be able to do that because it does have some of the best quality on surface stockpiles. Other people call them waste dumps. We in our universe they call stockpiles in South Africa. Because that's where they're situated, that whole Western Deep Levels, Kloof, Driefontein, that whole area, exceptionally high grades were mined in that particular area. So we were very keen on this project that was started by Gold Fields many years back. And when Sibanye-Stillwater was established, or Sibanye-Gold as it was initially referred to, obviously that came with a deal. And we were very fortunate to be given the opportunity to acquire that. But the acquisition essentially made us a part of the Sibanye-Stillwater group because Sibanye-Stillwater now owns 50.1% of the issued shares in DRD Gold. It was a two-stage transaction. The project was acquired for 38% of DRD Gold, and then subsequently Sibanye-Stillwater subscribed for an additional 12% to take its position to 50.1%. And that was with a cash subscription of just over R1 billion. Just over $80 million at the time, with no strings attached, obviously, other than deal with it responsibly. And that money is being used to further develop the Far West Gold circuit. So it's a beautiful circuit. At the moment, it's still only retreating one dam. It's busy establishing site for a second one that's targeted to come online in the second quarter of the calendar quarter of next calendar year. And it's only about 500,000 tons a month, so it's about 25% of the throughput of Ergo, but significantly higher grades.
So the one dam already is doing 200,000 tons per month.
No, it's doing 500,000. So we will have depleted the first one, and we'll move on to the second one during the course of this year, maintaining about 500,000 tons a month. And it's a very simple, relatively speaking, a simple process because it's one recovery site. It's only one active site and one deposition site with a plant that's quite a bit smaller than the Ergo plant. But it has its own set of metallurgical challenges. They had to put in a carbon extraction component in their process flow because there were significant quantities of carbon, and we believe that may be one of the reasons why it wasn't started earlier. There's signs on one of the dams that there was an attempt made at one stage. In fact, we know that there was to mine that dam. But,
when you talk about carbon extraction, as in there's graphite in the tailings dam, or is it carbon from the previous carbon and leach process?
Sorry, I meant to say copper. Did I say carbon?
You did say carbon. It might have been the connection. Okay, so the copper is preg robbing, is it? So the reagents react with the copper preferentially to the gold.
Well, yeah, and it also it plays havoc with your smelting and with your electrowinning rather. So it does impact your efficiency, and a higher copper content in your gold bar, in your doré bar, also attracts a penalty from Rand Refinery. So it does find its way. It sort of accompanies gold all the way, and then you have too high a percentage in your breakdown, in your makeup of your doré bar, and those penalties are quite significant. So it's pulled out. It's getting pulled out now. There is a little copper circuit, a little call it a mini plant. Copper comes out, and it's insignificant quantities. It's not something that's commercially. That can become part of the commercial makeup of this plant, but it did introduce some metallurgical complexity. That's now been dealt with. So we're now getting a much higher percentage of the gold that gets sent to Rand Refinery recognized. We don't have these penalties anymore. Basically paid for itself in, I think, 3 or 4 months, this little circuit, just because of the avoidance of these penalties or additional charges, I suppose, would be a more accurate description. So very, very simple, and it's got a long life. It's 250 million tons of, on average, higher grade material than what we're mining at Ergo. And ultimately, what we want to do there, and you will see some of those capital numbers coming through now, is double the size of the plant. The plant does have a capacity of 600,000 tons a month. We're using 500 at the moment because that is the rate at which we can store tailings. We can move tailings onto our tailings deposition facility. We have agreed with Sibanye-Stillwater to also convert one of their tailings that has spare capacity to become let's call it a second interim storage facility. There we'd be able to take volume to about 750,000 tons per month, and that we're targeting 2025 to start work there. And then ultimately, the site needs an own large tailings facility. We call it the RTSF, the Regional Tailings Storage Facility. Everything in mining is an acronym, and that also takes a while to master.
I was going to say it's particularly South African habit as well. You know, the acronyms.
Yeah, so that'll we'll hopefully start construction with that at about 2026. We're wanting to have a conversation with the regulator on some of the design specifications. It's been licensed and it's been approved, but we believe that we have a containment solution that is far more cost efficient, that is less risky, and that is no less effective than what is currently stipulated in the conditions for this dam. We believe it's going to take 2 to 3 years to get through that process, and hopefully it will be approved. We think that on merit, and not just merit in terms of what the regulator demands, but in terms of what the global community now demands in terms of environmental governance, we believe we have a solution for that. And then we can build the big dam to further extend the life of this operation. But it's a thing of beauty in its simplicity and in its neatness and just in its efficiency. So it's a wonderful circuit to have as part of the business. And it's really also, I mean, at Ergo is like an American battleship. You know, it works exceptionally well, but it's tough, it's hard. You know, you've got to understand it. You can't make mistakes. And what you learn there, you're going to apply it anywhere else. And anything else is just so simple. So we've got a wonderful combination, I think, of circuits at the moment.
What's the tonnage you've got at Ergo in the wider area?
Oh, no, it's vast. I think currently we recently just brought out our technical report summaries, and they were the SEC. And I might be incorrect. I may just have to check this, but I think it's 12 years, if I'm not mistaken. But that is also based on available deposition space. So there too, we're working at expanding the amount of tailings storage capacity that we have. And then it too could be expanded or extended in terms of life and mine quite significantly. There you won't see an increase in production. So that would be more a case of producing at the same level or similar levels for a longer period of time by having created additional capacity. Whereas at Far West, you're in fact looking at an increase in production once the second circuit comes in, and ultimately once it runs at full capacity at 1.2 million tons a month.
So what you've described as a very, very stable operation, and become almost kind of full circle in the conversation to what we started with, which is that you've got the expansion in Far West, if I understand it right, is likely to come through in a couple of years' time, in kind of mid-2025. So at least for the next 2 years, you've got a stable production base. And it's your job to manage the input costs as best you can, and then it's the job of the investor to judge the investment case relative to the gold price.
Yes, look, I think the reason why we have a measure of stability in the business at the moment is because of a whole host of capital investments, capital infrastructure investments that have been made over the years. For example, we have very extensive diesel backup power generating capacity. These are massive diesel generators to serve as backup capacity in the event that there's an interruption in the supply of power. Because we're dealing with tailings and with slurry, it has to stay in motion. If it settles, then it chokes. It takes weeks to clear. If a thickener trips, because you can't keep it in motion, then it's a 2-3 week interruption in the performance of that thickener. So we've had that over many years of that backup capacity. We've introduced measures to also deal with the impacts of climate change. The method of mining has changed to keep dirty and clean water separate, so that you don't have to accommodate everything through your plant, because that causes all sorts of things with your densities. It impacts your densities and so forth and so forth. So there have been a number of these. Water, for example, the availability of water. We relied extensively on the supplier of potable water in Johannesburg for water. Now 90% of our water is grey water, and that was also a deliberate decision taken many years ago. And we have I think, a very elegant integrated water circuit that pushes water into the most remote corners of the business, but also brings it back, only to push it back again. So it stays in a closed circuit. And these are things that, without realizing it almost, I think also the attention to what staff do, being more of an operator as opposed to a laborer, encouraging them to think, become part of the process, etc. All of these things, I think, have contributed. I mentioned the way that we deal with information and how that conversation takes place. All of these things have contributed, I believe, to creating a business that operates far more, that's far more stable, that's far more predictable. But you cannot stop, because there's always something else happening. At the moment, power in South Africa, electricity, is a big issue. And then you will have seen in our presentations that we've budgeted just over $40 million for the next year to build a 20 megawatt solar power station, and also accompanying power storage capacity. So there's always something new that you've got to deal with. The look and the feel and the underlying sort of value system in how we manage security, asset protection, and people protection, and so forth. It's not just a matter of capacity, but it's also the governance framework and the guidance, the values in terms of which they are trained to react, to maintain proportionality, etc., etc. So these are things that you've got to keep on going. You have to be very aware of where you are. We're in South Africa, where things have not been going particularly well on a number of issues. We have a growing body of very angry, disillusioned citizens because they're poor, they have no hope, and they don't get any services. How do you manage that, etc., etc.? So amidst that, I think we've managed to establish over time something that is fit for purpose, and that is fit for the environment within which it's operating. And we just need to continue to do that, because the ore body that we've got here is just too good to ignore. It's just too good to walk away from. There isn't another ore body of this size and scale with the available infrastructure that admittedly does need to be supplemented somewhat from the private sector here and there, but nowhere else does this exist. So you've got to really understand your risks and invest towards those risks in order to make sure that you can take full advantage of this. I can't go to the Fraser Institute saying that South Africa is one of the worst places to go and invest. Maybe so, if you rely entirely on the sort of environment that gets created for you. But if you get busy and start investing in some of those risks, and if you take ownership of some of those risks and create your own infrastructure and collaborate with other players in the industry, suddenly, before you know it, it could be one of the best jurisdictions within which to function as a business of this nature. Doesn't take away some of the unpleasantness that we've got to experience, but you can create your own environment and deal with some of those risks to the point where it becomes very, very attractive. And I think that's what we've got. I think we've got an exceptionally attractive business with a wonderful future, provided we continue to do the things that we've been doing. We just do them faster.
Thank you. That's a very impassioned. It's kind of no, it's fantastic. No, I mean, because I lived and worked in South Africa for many years, and one of the things that always struck me was in some ways it's isolation. It's and that's kind of stems from a political isolation through the bad years that we all know about. There's always been a degree of self-reliance in South Africa. You just kind of get up and you do it yourself. What you haven't mentioned is labor. How are you getting? Let's not talk about the rugby. But if you go to South Africa or the UK or Canada, there are a lot of South Africans living abroad, and we get a lot of the South African rugby players as well who are doing extremely well in the club and of course in the internationals as well. But as I said, I wouldn't talk about the rugby. But there are lots of mining engineers, metallurgists, and geologists who have moved abroad. What are you seeing about the education and the training and the people and the skills? Are you comfortable with that trajectory? I mean, you've mentioned the challenges on a host of other areas. Talk to me about the labour, please.
Yes. No, if I were comfortable with where it is, then I'd be lying to myself. I'd be living in illusion. None of these things are comfortable, and it takes discipline to manage those properly. I mean, I do encourage my colleagues, and they encourage me, that when a youngster in the organization, what does he hear in the first 5 minutes in the morning when you're having coffee together? What is your introduction to your day in that sort of that social interaction before you start working? Is it the 10 reasons why I'm moving to Australia or Canada, or is it the 15 reasons why I've decided to bat through the innings here and make it better? And we prefer for it to be the latter. You've got to be realistic about it, though. I would venture a guess here. I would say, and I don't think I'm wrong, but I think that there's political risk in South Africa. There are all sorts of things that can go wrong. And as a consequence, both because of the reality of the situation, but also because of shareholder pressure, a lot of companies move on. And I tell you what, I'm convinced that, and in fact, I think I sort of witnessed it 15 years ago, or 16 years ago in DRDGOLD, maybe a bit longer, 2003, 2004, how long is that? Let's say 18 years ago. I think I sort of witnessed something similar to what I'm going to describe to you now. When management moves on, they cause far more harm to a business than whatever political risk they're perceiving at that point in time. So there's this perception of political risk, and it's overwhelming, and the shareholders agree and say that you've got to move on. And look what the Fraser Institute say. Not suggesting that those things don't exist, but they actually do exist. But the true impact of those risks, if left unattended, are less than the impact of a management that moves on in its own mind and decides this has become non-core. I mean, that's when we lose interest in an asset, that's what we say. It's become non-core. And then we move on to something with more, that has more sex appeal. I think in South Africa, that's particularly true, where a lot of value has been left behind, left on the table, because management's moved on and it hasn't done what it still could do if it came to terms with its reality and it started owning and investing in its risk. And I think, look, it's easy for us to say because everything we do is sit on, it's already been stockpiled for us. But some of this actually did take a bit of effort, and some of these things do still require quite a bit of effort to do them properly. And if you do, it doesn't get any easier, but at least you see the results. And I think what you're seeing here is, this is a company that where a lot of companies have lost interest. That's retreating waste. It's got $150 million in cash. It has no debt. It's never. We hardly borrowed anything. We borrowed a little bit of money when we had to do the Far West Gold. But I think it really it took what it had and optimized it with the right mindset and said, there's something we can do about this risk. We can turn this into something good. And it had a board that allowed it to go and do those things and to fix its own mistakes as well. And when the gold price turned and became really favorable, I think this company could take advantage. So I honestly believe that it's doable. It just requires the right sort of mindset.
Niël, thank you so much. It's been absolutely fascinating talking to you. I'm sure the viewers will enjoy this. We've run out of our allotted time. I look forward to catching up with you another time, but thank you so much for this interview.
Yeah, please come and visit us. I'd love to show you what the plant looks like, what a 2 million ton a month operation looks like.
I look forward to that very much.
Lovely. Thanks, Merlin. Appreciate it.